ahead and kick things off. All right. Cool. Can you see my screen? All good?
Yes.
All right. Excellent. Well, thank you so much for everyone who gave some time today to join our conversation. We're going to be talking about leveraging portfolio analysis to improve your fund's IRR. And to kick things off, just a little bit of introduction. So my name is Belle, and I'm leading growth for our investor product. I'm really excited to be talking with Kristian today. Had the pleasure of meeting him in Bozeman actually recently, which was really excellent. And Kristian is the founder and CEO at FinStrat. And we'll just dive into actually a brief overview about FinStrat. I'll share some fun facts here, Kristian, and then have you add to it. But FinStrat Management was founded in 2017. They provide accounting, finance, reporting services to B2B SaaS companies, investor-backed companies, angels, family offices, and venture funds. And they've helped raise over $100 million in debt and equity financing on behalf of their startup clients. And we have some actually overlap in our customers, which is how we got to know the FinStrat team. Anything else you want to add here, Kristian, about yourself or about FinStrat to set some context?
Happy to. So as you mentioned, I founded the company back in 2017. Originally, when we started, the focus was on providing CFO-led accounting and finance services to founders. Since then, the company has evolved. And as I describe it, as we operate at the intersection of shared interests of founders and investors, both angels and VCs. And so whole scope of services. But the spirit of it is we're in this very unique position where we not only understand founders, what they're interested in terms of monetization, but similar with investors, both angels and VCs.
Excellent. And yes, and you've been a chartered financial analyst since 2004. So good context to add, just like the really in-depth understanding from the financial perspective, which we wanted to bring in today.
That's right. So next year we'll mark, oh my gosh, 2 decades as a CFA charter holder. So for those of you who may not be as familiar with the designation, international license, big in scope on investment analysis. Very fortunate to hold a handful of accounting investment roles over my career. And FinStrat Management was just a great way to help share my expertise and experience with the rest of the market.
Excellent. Thank you. And then we'll just quickly talk about Visible. I know some of you have joined us for previous webinars before or customers, but Visible's investor platform is all about post-investment monitoring and reporting. So Visible was founded in 2015. We've been profitable since 2017. We're supporting customers in over 47 countries and have over 350 venture funds on our platform, thousands of founders, and have users on 6 continents. So with that, we'll go ahead and hop in. Just so you guys know, feel free to use the chat function at the bottom of Zoom, so can submit questions through the Q&A feature. I may interrupt Kristian as we go through and ask some of those questions. Otherwise, we'll have time at the end for questions. And the webinar will be recorded and we'll send that out afterward. So how we're spending time together today is we're first going to dive into the importance of having an in-depth understanding of financial performance data, where to find benchmark data and how to use it, which metrics are most important and what they tell you. And then Kristian's actually going to share a dashboard example of how you can evaluate company performance. And then we'll end on kind of tips for moving from analysis to action. So with that, we'll go ahead and kick it off. And Kristian, would love for you to just kind of touch on like the why behind portfolio insights. Investors obviously spend a lot of time doing diligence on companies before they invest. but why is it important to continue to understand financial performance of your companies after investment?
So generally speaking, whenever we attempt anything, we'll ask the question, what's the objective? And we find that if we begin with the end in mind, it puts us on the right path. And so in the world of investors, I'll oversimplify it, but I'd say most people would agree that you're looking for a return. That return can be in the form of a future sale, perhaps not as typical of an early stage business, but it can also be in the form of dividends. But understanding that is the objective of many investors, to see a return on their money. The question just becomes, are there any steps that can be taken to either increase the probability of hitting an investment threshold, or simply just increasing the net return? In our experience, the answer is yes. But with any improvement, it really begins with measurement. And so, a little bit outside the scope of what we're talking about, but effectively, this is quality improvement or improvement in general. And there are entire industries, whether it's manufacturing, healthcare, but investment analysis, where the concept holds true. And really, the starting point is saying is, if I know I want to measure a return, well, then I need to understand how that company is performing. I may need to get a third-party valuation, but in any regard, it just starts with the data. Now, this slide does a really good job of asking the next question. It's like, well, presuming I have that information, how often should I measure? And that's actually a question that is gets asked in a lot of different industries. Really, the answer comes down is, well, what are you going to do with the information? If any investor had their finger on the pulse and they were getting daily updates, my position would be, that's great, but what are you going to do with it? As compared to, I find most institutional investors are in a position where they have the underlying infrastructure to assess and potentially take action on information on a quarterly basis. It varies. We work with some VCs who do it more frequently, monthly, others twice annually, maybe even some instances annually. I don't know that there's a right or wrong answer per se. One of the themes you'll see that's going to come up today is this concept of risk stratification, right? What's the profile of the investment? Are they pre-revenue, or are they getting ready for a Series F? Two materially different types of companies. But in any event, those are the macro themes that I find are a great starting point for answering the question why, and then how frequently.
Excellent. Yeah, and this chart here is a survey response that we did with investors. And so asking them, how frequently does your team hold portfolio review meetings? And so, yeah, most investors are doing this on a quarterly basis, and then weekly and monthly as well, but just kind of depends on your firm. But that's just to kind of add some context to that chart there. And then one more question for you, Kristian. So what we see at Visible is the type of people collecting financial data from companies oftentimes do come from a financial background, but other times they're operators and maybe didn't study finance and don't have that kind of in-depth understanding. And actually, when I was a platform manager previously, I kind of fell into that camp of being more of an operator. So really excited for today. But what advice would you have for kind of non-financial people to upskill in data analysis to be able to create meaningful insights for their team?
It's a very good question. And so, a moment ago, I referenced the quality of the underlying data, and it's somewhat funny. I don't know that I paid much attention in elementary school, but one thing that stuck with me was, I remember the teacher saying GIGO, and I don't know if they still teach that, but the concept would garbage in, garbage out. And the spirit of it is any analysis is only going to be as good as to the integrity of the data set that you're using. And there are other considerations. Size of the data set would be another. I know we're going to be talking about medians and benchmarks here shortly. Mm-hmm. But a lot of what we're going to look at today is only possible because financials are prepared on a GAAP compliant basis, so accrual versus cash. And if we start to unpack that, even if founders had an accounting and finance background, I'd argue that it's not the best use of their time. Better spent on product development and sales and marketing. And so if there's consensus that that's the case, then the question just becomes, well, do you employ a full-time team? Do you look for a partner? A lot of choices. I think the short of it is that regardless of the path anyone takes, that just knowing that you have a clean set in the US, US GAAP compliant financials is a must. And you will see this later on, but a very practical example would be if we're going to calculate customer acquisition cost payback period, and whoever's preparing your financials is putting all payroll for G&A, product development and sales and marketing in a G&A bucket, well, we already know that the metric isn't going to be useful because our customer acquisition cost is understated.
Mm-hmm. A very CFO response to the answer. I like it. Got very in depth, but that was really helpful. And so just would love to also hear from you, why is understanding portfolio insights maybe more important now in this current market than maybe in the past 4 years in VC?
So in my experience, and I think there'd be general consensus, cash is the lifeblood of any company, right? Companies go out of business for one reason: they run out of cash. And if you think of the profile of investments that institutions like VCs are targeting, they're generally early stage, i.e. they're not yet profitable. And so historically, prior to the Federal Reserve starting to raise rates in March of last year, because money was inexpensive, it was plentiful, but also the risk profile for limited partners was different. It was more acceptable to take early stage risk because of the lack of options that were out there. And that's changed. And so we've had the longest string of interest rates by the US central bank since the early 1980s. And that has a downstream effect on lending practices. And, probably have a webinar dedicated to Silicon Valley Bank, but we saw firsthand of what happens when institutions don't anticipate that risk. And so question then just becomes, well, what happens in the early stage investing space? My sense from where I sit is the landscape is changing, for better or for worse. But what I see is limited partners now have more options. And the consequence is that for a VC to raise additional funds becomes harder. For a VC to respond to a portfolio company request to do a bridge round or participate in a round becomes harder. The potential for a down round increases, which has the potential to create tension between a portfolio company and a VC, depending on the scope of the relationship. It has the potential to create tension with the VC and the LPs. And so the upside is, it is asking founders and investors to ask some difficult questions. One of the things that I see now is a bigger appreciation on profitability, something that you don't normally see with an early stage company. And that's not an absolute by any means. I'll talk here in a little bit about some of the trends that we're seeing that are still pre-interest rate rise, that I think is some bit of good news for companies that have great growth profiles. But the landscape's definitely changing. And the short of it is that because money is more expensive and investors have more options, that there's going to be a significant amount more emphasis placed on performance. On a quick side note, Belle, I know you mentioned that we have overlapping clients, and I don't know that either of us mentioned that FinStrat Management uses Visible's tool. But frankly, I think this conversation is really pertinent because the tool does a great job. answering the performance question.
Excellent. Yeah, and what we're seeing at Visible is, people are diving into the data now more than ever. And so bridge rounds and follow-on rounds actually becoming more common to kind of help companies bridge the gap between their next price round. But investors using their performance data to make those decisions. So if they only have a certain amount of capital that they can allocate to follow-on rounds, who in their portfolio are they going to choose? Well, they really need to understand those performance metrics in depth. So from our perspective, that's kind of how we're seeing investors use that as well. All right, so next topic, all about benchmarks and medians. So Kristian, what is the value of benchmarks and medians, and where can people find some of this data, or how is FinStrat coming up with the benchmarks that they're using when they're supporting companies?
So if we're going to answer a performance question, we have to answer relative to what, in the simplest terms. And so are we measuring performance relative to the past for an individual company? Are we measuring performance relative to other portfolio companies within a fund, a segment, or the nation at large? Mm-hmm. And so before we can do any amount of this investment analysis, we need a yardstick. Mm-hmm. And in our experience, there's a couple ways to approach this. There's medians. There's just taking your existing portfolio and measuring what the median is on an individual basis. Now, again, there could be, it may not be statistically valid if your entire portfolio is skewed in one direction. Mm-hmm. And so that introduces a larger concept. You're just using a benchmark. And the spirit of the benchmark is it's intended to be perhaps a bit more objective, because it includes values outside of your fund. And so the question just becomes then, okay, well, what are some great sources? Well, before you can do that, we have to talk about, whether we like it or not, our old statistics class, the size of the sample. It has to be statistically valid. I don't know that there's a hard and fast rule. In my experience, at a minimum, you need 30. Mm-hmm. I will oversimplify it and say the more the better. But as if your data set includes hundreds of data points, the better, because then we start to eliminate noise. Where to find benchmarks? Well, you've got two great sources up on here. For everybody's benefit, these are survey-based benchmarks, and they've been growing. If you go out to their websites, I think if you share your email address, you can find their most recent reports. Mm-hmm. Alternatively, FinStrat's in a unique position, is that because of our client base, we also have access to benchmarks that we can use as well. And then last but not least, another source, it does a little bit more work that's involved, and albeit it's public, not private. But in the past, we've used SEC filings for public SaaS companies. You have to do a little bit of math by teasing the information out of their 10Ks. But I think there's an even more important subject here, and is that I can look at growth rate. But growth rate, should I use the same yardstick for every company? Our position is no. We want to start creating a profile for the investment. So really easy example would be, what's the company's ARR? Mm-hmm. Our position would be, if you're under $1 million ARR, probably don't want to compare you to if you're at $1 billion ARR. And I can extrapolate that same concept to a whole host of metrics. And to at least, OpenView's and benchmark, it's a credit. If you take a look at their benchmarks they publish, they stratify their respondents to give you a really good sense to better hone in on what's a good answer based on an individual company. Mm-hmm.
Definitely. Yeah, and I saw someone write into Q&A just asking if we can share the links to these two sources that we have here, and we'll definitely follow up with that. Visible, yeah, we really like the content from OpenView and the reports that they put together. And today we're actually going to look at data from Benchmark and kind of look at some of the recent trends in some key performance metrics. So we'll definitely follow up with those links. But yeah, definitely important to think about when you're benchmarking your companies, how to thoughtfully segment them by sector or by stage or potentially by region as well. So yeah, now we'll go ahead and actually do a deep dive into some important performance metrics. And again, pulling in that CFO lens and talking about why these are important and how they could be applied to, at your fund when you're looking at portfolio company performance as well. So first, we're going to talk about growth rates, which Kristian actually just alluded to in just a moment. So Kristian, what are growth rates? Why are they important? And then, yeah, if you want to talk to some of the data here that's on the slide as well.
So historically, though even today in our higher interest world, most investors who are looking at early stage businesses use revenue growth as the holy grail as to the company's prospects, i.e., I'm not interested in profitability. In fact, if you're profitable, why aren't you reinvesting that money into product development or sales and marketing?
Mm-hmm.
And so in our experience, we use monthly MRR growth rate and
Mm-hmm.
all of its individual subcomponents. So just, a very brief tutorial. If you look at net MRR, it consists of new sales, expansion sales or additional sales from existing clients, as well as gross churn. So
Mm-hmm.
revenue lost either because an existing client purchased less in a given month, or you just lost that client altogether. As I mentioned earlier, using growth rate as a yardstick, you can see here on the slide, really depends on the size of the company.
Mm-hmm.
It's not fair to say that on average, a business that's doing $1 billion in ARR should have the same growth expectations that a company that's doing $1 million in ARR.
Mm-hmm.
But in our experience, I would say maybe it's not too controversial to use 10%, if just on average, on what a healthy month-over-month growth rate is. But I can also make a case that for early stage businesses who may not yet have a solid handle on their growth strategy, that they're at 5 or less percent. I mean, this is just one metric of many before I would ever pass an assessment on an individual company.
Mm-hmm. Yeah, and so this data again is from that benchmark resource that we mentioned. And so just to kind of earmark on this, 30% was the average from 2022 financial year. And then just kind of looking at the differences across the board again, based off of the size of the company and how much that can differ. But yeah, when you guys think about evaluating company performance within your own portfolios, can kind of keep that 30% in mind as the average, but then again, really thinking about the importance of segmenting your portfolio companies. And small plug for Visible is we have a benchmarking solution built into our platform that does allow you to segment your companies pretty easily. And so making that easier to identify across the board.
And great news, we actually prepared that when we cut over to the
okay. Great. And yeah, next, rule of 40. What is the rule of 40? If people haven't heard of it before, why is it important? What does it tell an investor or someone evaluating company performance?
Yeah, so the rule of 40 builds on growth by factoring in profitability. So you've included the formula up here, but effectively it's the combination of revenue growth rate and net margin or net income margin. You could substitute EBITDA if you wanted to. There's sure we couldn't find a shortage of people who would say whether or not it's more appropriately, but in either event, the spirit of it is to say the industry has set a threshold of 40%. And if you're not profitable, then your growth rate better make up for your lack of profitability by getting you over 40. On the flip side, if your growth rate was anemic, there's an expectation that you're profitable, and you're profitable to the point that your net margins more than make up for your lack of growth, by terms of profitability.
Mhm.
Again, individual metric, not intended to say this is the end all be all. However, given the higher interest rate environment, one of the things that we see is that this metric in particular has taken on new meaning because of the emphasis on profitability that I
Mhm.
mentioned earlier, i.e. money's more difficult to come by. And so there's an expectation now that if you're not growing, we want to see you not need additional cash in the future because you're profitable or you're close to profitable.
Mhm. Yeah, and I think you kind of just answered this, but yeah, there's a spike here in 2021 that we saw, so 42% across the board. Why would you think or hypothesize that it was much higher in 21 than 22?
So I don't know how much credit I will give to the first half of the year, but if we were to take a look at this on a quarter basis, I'd be willing to bet a nice dinner that a lot of this was taking place in the second half of the year when the writing on the wall was clear. The Fed was raising rates, and money was going to be more expensive.
Mm-hmm.
Now, on that note, for benefit of your readers, I don't know if everyone's familiar with Tomesh Tungas. He does weekly posts, very sharp. And back in March, he put out a piece, How Markets Value Software Companies in 2023. It was
Mm-hmm.
very enlightening. And so there's been a common narrative right now that the big emphasis for early stage business is profitability, when in actuality, using public SaaS companies as a litmus test, that it's not actually the case. There is a percentile of businesses that are still receiving funding because of their growth rate and who are not profitable.
Mm-hmm.
And so definitely think it's a valuable takeaway because my sense is that this discussion around profitability has creeped into a lot of boardrooms, but it doesn't necessarily have to be the case if the growth is there, top
Mm-hmm.
line growth is there.
Excellent. And then someone asked if you can repeat the name of the person that you mentioned. I'll probably butcher it, so I'll have you say his name again.
Yes, it's Tomas. It's spelled Tomasz, as in Zulu, Tungas, and the last name is spelled Tunguz.
And I'll just reply to everyone to take a look at his content, and we can follow up with a link with some of his reports as well. All right, so next one that we'll dive into is CAC payback period. So what is this and why is this important?
So I admit this is somewhat of one of my personal favorite metrics. This particular metric's answering the question, how long does it take for a company to recoup the money it spends to acquire a new client?
Mm-hmm.
And so I'll oversimplify it. Let's say it took a month. That's great. You're near printing money. There's implications in there as well, but let's then compare that to, say, I'm going to exaggerate to make my point, 10 years, right? So you spend $10,000 to pick up a client, but you don't earn that money back until a decade later.
Mm-hmm.
You better be making wine because it's not going to be a sustainable business because the amount of cash that you're going to need to support that model is going to be excessive.
Mm-hmm.
And so this starts to answer the question, and there's a lot of probably a separate webinar as well, but a lot of SaaS metrics is just algebra, right? So if you think about customer acquisition cost payback period, it's answering the question of, am I charging enough? So it's looking at average revenue per account.
Mm-hmm.
Am I selling to the right people? Because if you're selling to small deals or enterprise deals, that'll have an impact on ARP, average revenue per account. It's also
Mm-hmm.
answering the question, how much am I spending to acquire customers? So customer acquisition costs, I'll oversimplify, but it's just effectively taking your entire sales and marketing bucket from operating expense
Mm-hmm.
and saying, this is the money that I'm spending to acquire customers. Now you can get a little bit creative with this. I know there's opportunities to do trailing 6 months. The idea being the money spent in 1 month doesn't necessarily correlate to any clients picked in that month because sales cycles could be greater than 30 days. But the spirit of it is basically answering is, how long does it take me to recoup this? And the smaller the number, the better. Again, if it was 1 month, you can make an argument that you should be spending a lot more on sales and marketing to pick up more customers, but that just gets into a broader sales and marketing strategy. For as far as benchmarks go, we have historically used 12 months within FinStrat. Basically, the idea is as you go longer in the tooth, i.e. greater than a year, we want to understand why. Because especially in this environment where cash is harder to come by, it means that your growth better be commensurate with the longer amount of time it takes for you to recoup the money you had to outlay to pick up that client.
Definitely. Yeah, and just from the benchmark kit, average that they're seeing is 17 months, but again, just interesting stratification down here. So looking at this data based off of the average annual contract value and how that can vary. So as you're evaluating a company's CAC payback period, just kind of keeping in mind the size of the contracts that they're closing as well, if you're having that in-depth conversation with portfolio companies.
Yeah, and what I would just add is, if it's intuitive that the larger the company, odds are you start to shift, in order to maintain your revenue growth, you start to shift away from either consumers or small businesses to enterprise. And if you think about the sales cycles and the costs associated with closing an enterprise deal, it's materially larger than it is for small business. And so this kind of goes back to stratifying your population within your fund. I absolutely want to know, am I looking at pre-revenue, early stage, series A, B, C, D? And then what's the underlying product that's being sold? These are all, the answers to those questions all will contribute to expectations around what you use as a yardstick.
Definitely. All right, the final metric that we're going to talk about here before we transition into actually looking at some data in a dashboard is net revenue retention. So Kristian, can you walk us through why this is an important metric to understand?
Sure. So this metric, as compared to gross revenue retention, which will never be greater than 100, can be greater than 100 or less than 100. In simplest terms, it's asking the question, if I just take my existing clients, i.e. exclude new sales, is that cohort growing month over month? And so we're taking existing reoccurring revenue, in the case of software, we're adding any expansion revenue, but then we're subtracting churn, whether it's because the client purchased less or because you lost the client. All things equal, the greater the number, the better. That means that not only have you successfully closed someone, they're sticking around, but they're buying more. And so, the whole host of ways you can look at this. There's also a concept of negative net churn. But in simplest terms, I mentioned earlier, if we start to break down the components of revenue, net, expansion, churn, you could make a case that in the absence of new sales, because you operate in a mature space, that's acceptable if you are able to land and expand, and if we're perhaps at first mover advantage and have a large enough client base. Any event, this is a proxy that helps answer questions of, are you selling to the right people? Is your product sticky? Do they like what you're selling them? Because if the answer to those questions are yes, you'll see a higher number.
Excellent. All right, I think that we will go ahead and transition to having Kristian share a dashboard where he has mocked up some of this data, and we'll talk about it in greater depth. So I will actually stop sharing my screen and let you share. And if we have any issues, I'll just have you send the link to me, Kristian. Oh, but we're already good to go. All right, and I actually don't know what you have mocked up, so I'm excited to check it out.
Yes. Just caveat, this is a demo environment. All the information is fictitious. We put this together in support of this webinar. And so, on behalf of the team, I hope that you get as much out of this tool that I know that we do and our clients do. But the spirit of this demo right now is to build on what we talked about. And so, hypothetical scenarios about, I think, Belle, you mentioned it, is a portfolio company, let's say it's Cybersphere, fictitious company. And if by sheer coincidence that company exists, it's a sheer coincidence. But let's say Cybersphere comes to you and says, hey, I need a bridge round. We're running out of cash, or we're near running out of cash. I have concerns. I'm not in a position yet where I can do a next round of financing, but hey, institutional investor, I need your help. And so what this view is something that a VC would look at. In this particular case, they have 5 funds. You can see the total count of funds in here are just, what is this, over a dozen, 16. And as part of the power of Visible's dashboards that, and I presume everyone knows this, but it's the ability to intake and publish individual, but also performance on an aggregate basis. So what we would do, just for starting point, is we would just look at the individual company. We've taken the liberty of creating individual dashboards, P&L, balance sheet, ratios, and SaaS metrics. Just to dovetail into the larger deck, we'll start with a look at P&L. If I had my CFO hat on, I would just start looking at revenue because I care about growth. I'm going to care about average revenue per account. I'm going to care about customer acquisition costs. So you can see here, we've published a breakdown of the 3 buckets for operating expense, product development, sales and marketing, and G&A. I'm going to look at benchmarks. Are they spending enough? They're not too much. What's the trend? Are they profitable? And so this is an analysis that I personally would start on an individual basis before I toggle my attention over to the larger fund as a whole. We've also prepared SaaS metrics. And so earlier I was sharing that the components of MRR, net, new, expansion, and churn. And so I would take a moment and I would start looking at the individual components. How have they been trending? Do I see any new trends coming out at me? I see that revenue is starting to break out to an all-time high. So there's a growth story here. Question is going to be whether it's enough. I can see that December, this was 8%, but then on a trailing 6-month basis is 1.65. So I don't know, is this a one-off? Given that historically they have been underperforming. I can look at trends in average revenue per account. Let's see, where'd you go? I can see that it's been generally flat versus increasing. And this is going to have an impact on customer acquisition cost payback period. I can see they've been spending a lot more money on sales and marketing. I'd want to understand why. Have we been making new hires? Have we employed a new marketing firm? Or devoting more money to Google AdWords? What's driving this? And am I seeing a commensurate increase? Is this enough? And then, where did I go past yet? And then I can see here that the company's customer acquisition payback period is now at 15% coming out of July. Now, historically, prior to February this year, they've been under 12. It makes sense. We're now starting to see this uptick in sales and marketing expense. Question is this sustainable? So I would want to then turn over my attention to the balance sheet and start looking at just their cash. I can see as of today, they have 1.1. I can see they're changing cash and I can get a sense of their runway. According to their expense profile, I have less than 2 years. Again, this is a demo environment, but who knows, maybe they have some initiatives in mind, which is why they're coming for the bridge round. But these are the types of questions that I'm going to ask as a CFO. These are the types of questions in my experience that other VCs are going to ask. To start answering this question on an individual client basis, do I like what I see? So from there, I would then toggle my attention over to a comparison dashboard. And so here we've published all of the companies that were in Fund 5, because if we start to think about portfolio management, if I put my CFA Institute hat on, there is a case to be made that returns are predicated on winners and that I want to bet on my winners and add to my winners as compared to this concept of simply cutting my losses short, i.e. why throw good money after bad? Now, in the case of Cybersphere, I'm not saying that's the case, but that's the mindset that at least I bring if I'm going to answer a question, do I want to participate in a bridge round? And so you can see here, I can start saying, well, okay, I see how Cybersphere is doing, but how are the rest of the companies in my portfolio company doing? Are they better or are they worse? One of the reasons, on a side note, why we like Visible is that not only is a graphical format, but there's table format as well, depending on your preferences. And we can also see this as a time series, which just makes it easier for me to read. Similar concepts on revenue. I'm going to look at revenue growth over time. You can see in this example that we set a benchmark that's at 6% month over month. And now this starts help answering the question, how is Cybersphere doing not only to my benchmark, but to the other companies in the portfolio? And then we can start looking at similar conversations around EBITDA. You know, how far close or far are they from profitability? And is my expectation good? But again, I'm looking at a fund. There's value in expanding the scope of this to include additional benchmarks and medians. Obviously, it's a bit harder to get a benchmark on a loss, but you know, this is also why you have investment committees and using the collective wisdom and experience of your team to say, you know, what's acceptable, or at least for our investment thesis, you know, depending on what expectations we're setting with LPs. Similar concepts. I want to understand cash runway. It's one thing to know that they may have X amount of months. It's another thing to know whether or not that's in line with my expectations or the rest of my portfolio companies. And so, long way of saying that if I'm going to answer a question, am I going to participate in a bridge round? I'm going to start with the individual company. Do I understand them? How are they currently performing? How have they been performing in the past? I generally will at least look back a year, if not, you know, 2. Circumstances can vary. Do I think the immediate past is more valuable than a year ago? I do, but I'm also conscious that 1 month doesn't make a trend. But then I'm still just from my experience, if I'm going to make a decision to cut a check, I'm going to look at it in the aggregate. You know, a whole host of considerations. I probably need an additional call to distill them, but in simplest terms, I would say I've found success in returns in riding winners, and I've seen a lot of investors see success in not throwing good money after bad. And this is, in our experience, is a great tool to help answer those questions.
Excellent. Anyone have questions for Kristian? Feel free to write those into the chat. I've obviously enjoyed this being demoed our product to myself. I love this, but really like what you've mocked up and think it's really important and a great use case of how to actually make meaning out of this data that you're collecting from your portfolio companies and how to use it.
And I know the title of this is how to utilize what we talked about to improve IRR. I think I'll connect the dots just because I know I think it's the next slide coming up and it will be shared. But
yeah,
you know, if we go back to that objective of generating a return, you know, there are different methodologies that investors employ. You know, there's the spray and pray, where you cut a lot of checks in a larger portfolio with the expectation that the returns that you gain from a fraction of your portfolio will eclipse the loss associated with a larger percentage. Albeit they're in value investors like Warren Buffett, who are very methodical in their decision-making process and will only cut a check because their confidence is extremely high. And so it's a long way of saying I don't know that it's a one-size-fit-all, but at least if our attention is focused on the VC, I do think there's an expectation that you should be prepared to engage your portfolio companies with advice. If you can support it with insights into benchmarks and median for the portfolio, it's very valuable feedback, I think, for a founder to receive, because they can then say, okay, maybe I am spending too much on sales and marketing, or maybe I need to increase my prices in order to generate a larger average revenue per account, or simply rethink my strategy. But those conversations are easier to have when you have this support. You know, the other part of that then too is, again, just knowing where to place additional bets, if you will, and all of which has the potential to increase the return on the fund.
Yeah, definitely. Thank you for the kind of the summary there. Yeah, and those were going to be our final slides. I'll go ahead and share my screen again, just to kind of wrap things up here. If you guys have questions, feel free to throw those in the chat. Otherwise, we can conclude here a little bit early, but just to kind of make our way through here. This is kind of what Kristian just touched on, but when thinking about how to move from just kind of being in the data and extracting the insights to actual action, definitely from my experience supporting founders, if they're a first-time founder, they care and they love and they appreciate the benchmark data that you can actually bring to inform their strategy. And you as an investor coming to meetings with companies with data and being really thoughtful obviously sets a really great tone and relationship to your dynamic of working with companies. And then another point here of just how you can use kind of your insights is to provide more thoughtful updates to your LPs. So instead of kind of sending just a generic overview of portfolio performance, to kind of extract some of those insights of, what are the average, CAC payback period in your portfolio versus benchmarks, who are, your star players versus the companies that you maybe have concerns about and what you're doing about it. So just providing a lot more robust feedback and context to your LPs can be really impressive. And then we touched on this one, but just informing your investments, whether it's follow-on capital or how you think about, investing in the future as well.
And I think you read my mind on there at the end, Belle, but I didn't touch on it because we were talking in the context of existing portfolio companies. But you're right, as companies are evaluating new investments, and presuming that this information is shared with them, it's possible to make a comparison to help inform whether or not to sign that term sheet.
Definitely. All right, and then we already kind of connected the dots and did a summary on how to use this to improve your firm's IRR. So if you guys have questions, which I didn't see any in the chat right now, which is totally fine, but feel free to follow up with us via email. Kristian, where's a great place to learn more about FinStrat or to get in contact with your team?
So company's website is FinStrat, so FinStrat, and then it's MGMT, short for management.com. And you're welcome to use the contact us there. If you'd like to email me, it's my first initial K, my last name Marquez, so KMARQUEZ, at the same domain, FinStratMGMT.com.
Excellent. All right. Well, thank you so much for your time, Kristian, and for everyone who joined us. We'll be sending a follow-up with some of the resources that was discussed today, and also the recording of the webinar. So thanks again.
Thank you, Bill.